Hello, my name is Cassandra Dorleen. My group was given $1 million with which to create a stock portfolio. So, what is a stock portfolio? Well, it's essentially one's collection of financial securities, such as stocks and bonds. We invested in 7 stocks at their closing prices on September 20th, 2016. A stock represents a unit of ownership in a company. We chose the following stocks based on reputation and trends we observed preceding September 20th. We decided to invest in 2,680 shares of Starbucks at $53.30, 1,537 shares of Disney at $92.95, 4,400 shares of Sony at $32.46, 1,258 shares of Apple at $113.57, 2,604 shares of Nike at $54.86, 1,587 shares of CVS at $89.99, and finally 3,571 shares of AT&T at $40. The winners and losers of the stocks in our portfolio were based on the prices at which they closed on Wednesday, December 7th, 2016. So let's examine where these 78 days have brought us. The tools used to gauge our progress were the current asset ratio, which is a liquidity ratio used to measure a company's ability to pay its short-term and long-term obligations. The quick ratio, also known as the acid test ratio, measures how well a company can satisfy its short-term liabilities. ROI, or return on investment, measures an investment's profitability. Total asset turnover measures a firm's efficiency from its ability to generate sales. Debt ratio represents the proportion of a company's assets which are financed by debt. Times interest earned ratio determines a company's ability to make its debt payments. ROE, or return on equity, shows us how much profit a company has generated with the money invested by shareholders. Gross profit margin shows what money is left over from revenue after accounting for cost of goods sold. Cash flows are simply the liquid money coming into and leaving the company. In the end, our portfolio lost $12,531.88. A diversified portfolio might have benefited us more. Starbucks and Disney made us major profits, while Sony and CVS were the weakest of our stocks. Of Starbucks and Disney, which would you guess did better? The answer is Starbucks. It increased by $14,606, which is a 10% increase, while Disney increased by 9.7%. Of Sony and CVS, which would you guess did worse? The answer is Sony. Sony lost us $17,116, which is a 12% decrease, while CVS showed a 10.5% decrease. I'm going to hand this over to Michelle Bradley now, who will kick things off by discussing our winner, Starbucks.
We will now look into the Starbucks Corporation. Hello, my name is Michelle Bradley, and I will be going over different ratios for the company that provided us with the most economic revenue, the Starbucks Corporation. Ratios restate data in relative terms to show company strengths and weaknesses. It goes over long-term historical trends and lets us know if company management is performing well enough to entrust money in their company. There are various components of a company's cash flow and income statement that provide income insights to the liquidity, management, financing, and owner's return. First, I will go over the liquidity side of Starbucks to determine how well they manage debt, assets, and cash. The current ratio is defined as assets plus inventory divided by liabilities plus inventory. These are all found on the balance sheet of a corporation. For Starbucks, this amounts to a ratio of 1.6. This ratio means that for every $1 in liability, Starbucks has a current assets of $1.60. We want this number to be high, especially in relation to similar companies. The industry average is 0.73, indicating that Starbucks is performing well in terms of its assets to liability ratio. Another ratio we can look at when we analyze liquidity is the quick ratio, which is current assets minus inventory divided by current liabilities. This ratio is 0.743. This is analyzed by saying that for every $1 in liability, Starbucks has 74 cents in current assets less inventory. When comparing this ratio to the current ratio, we can see how much value Starbucks is holding with inventory as opposed to cash on hand. Since this is lower than the current ratio, Starbucks tends to keep a high inventory. However, the quick ratio is still higher than the industry average of 0.66, so Starbucks' assets to liability ratio is performing well. I will now go over the managerial side of Starbucks, a very important component of a company's potential profitability because it's the current management's decisions making that will generate potential economic downfalls or triumphs. ROI, or return on investment, is defined by operating income divided by total assets. For Starbucks, this is 0.078. This means that for every $1 in assets, Starbucks obtains 7.8 cents in operating income. In comparison to the industry average, Starbucks isn't performing well. Other fast food restaurants have an ROI of 20.57%. Therefore, the ROI is a cause for concern. TAT, or total asset turnover, is determined as sales divided by total assets. For Starbucks, this is 0.398. Typically, this number is greater than 1, and we prefer it to be high. However, the industry average is 0.77, indicating it is less of a cause for concern. Yet still, Starbucks has a high TAT and a low ROI, indicating that there is potential managerial impacts that have created far less operating income from a high amount of sales. Now we will look at the financing of Starbucks Corporation. The debt ratio is defined as the total debt divided by the total assets. It's used to show that for every $1 in assets, how much money the company has in debt. For Starbucks, they have 59 cents for every $1 in assets. Time interest earned is a ratio in which Starbucks excels. This ratio is operating income divided by interest expense. The company has very little interest it has to pay in relation to its income. When this ratio is higher, it means that the company has a greater safety margin and is lower risk. The operating income can fall as much as 60 times the interest expense, and the company would still be able to service its debt. I will now go over the owner's return. The ROE, or return on equity, is another important ratio. It determines the management's ability to generate sales and shareholders to get a solid amount of that share. This value of 49.69% is provided for us on the useful platform Tingo. It essentially states that for every $1 in equity, Starbucks obtains 49 cents in net income. In comparison to the industry average of 41.4%, this is fairly high and indicates that Starbucks is a good investment. Our last section is profit margins, where we will analyze the gross profit margin of Starbucks. This ratio is found by dividing gross profit by total revenue. Our gross profit margin is 31%, which means that for every $1 of sales, we obtain 31 cents in profit after paying the cost of goods sold. The industry average is 43%, indicating that Starbucks' gross profit margins are not as high. This furthers the concern obtained back when we were talking about ROI. We will now look into the cash flows of Starbucks, found in the steps provided in the slide. For Starbucks, their free cash flows is 0.87, indicating that it has cash to spend on itself. In summary, Starbucks performs well on liquidity, financing, and owner's return. However, it needs to improve on its managerial ratios and profit margins. There is cause for concern in terms of its operating income. In general, this was our highest performing stock, and many of the ratios agree with this sentiment. This concludes the ratio side of Starbucks. We will now look into the intrinsic value of its stock.
I'm Shu Li. I'm going to talk about the best stock from our portfolio, which is Starbucks, and its intrinsic value, PE, PEG, beta, and CAPM. On the next slide, we can see that the PE ratio is 30.92, and as it is compared to the industry, it is 64.13%, which is considered high. And on the next slide, we see beta is 2.27%. PE is 30.92. ROE is 49.69%. Earnings per share is 54 cents. And dividend per share is 25 cents. To find PEG, I need to know the growth rates, and to find growth rates, I use ROE times the retention rate. And to find retention rate, I use dividend per share divided by earnings per share. That gives me 46.29%. And I use that times ROE, which is 49.69%, gives me the growth rate of the company is 23%. And divided by PE, PEG comes out to be 7.11%. Now we know beta is greater than 1, meaning the stock has high risk and high return. PE, although PE is 30.92, that is considering high, but PEG is 7.11%, which is considered low, and because growth rate is high. Therefore, it is a good investment. On the next slide, we see that according to Treasury, the risk-free rate is 2.99%. Beta is 2.27% according to Tingo. And the expected return rate is 2.36%. Here I use the year-to-date return for Starbucks. And so the CAPM comes out to be 2.98%. CAPM shows the correlations of risk and return for the company, for the stock, and the 2.98% is actually the expected yearly return for Starbucks. On the next slide, we evaluate the intrinsic value of the stock. I use the dividend growth model, whereas I divided by the required rate, subtract dividend growth rate by the dividend rate. Right now, we see dividend is paying at $1 per share, and the required rate is 1.70%, which is equals dividend yield. That's the required rates that I'm using, and the growth rate is 0.17%. So the intrinsic value of Starbucks stock is 65.36 cents, as opposed to stockholders paying $58.75 on the market as of December 9th.
Hello, my name is Edwin Gote, and for this part of our presentation, I will be focusing on several different ratios and margins that will help analyze why it is that a company like Sony was our worst stock option from our portfolio. I will also be taking a look at some long-term historical trends from the company Sony, such as the balance sheet from 2016 and 2015, and the income statement as well, provided by the software Tango. This information will help me conceptualize these margins and ratios. The first ratio we look at is the current ratio. Recall that the current ratio helps measure a company's liquidity. We find this ratio by taking our current assets and dividing them by our current liabilities. Taking these values from Sony's balance sheet, we find that Sony has a current ratio of 0.87. Generally speaking, this means that Sony's liabilities are greater than its assets. However, one must also compare this ratio to Sony's competitors before drawing any conclusions. Next, we look at the ROI ratio, or the return on investment ratio. We find this ratio by taking Sony's operating income and dividing it by the total assets, which gives us a 1.7% return on investment. Unfortunately for Sony, the average for the industry is an 11.4. We'll jump to the total asset turnover ratio, and this ratio actually brings us some good news for Sony. Just a quick reminder that the ratio will tell us how good Sony is at using its assets to generate revenue. So to find this, we will take our total sales and divide it by the total assets, and we'll see that the ratio is 0.49, meaning that for every dollar in total assets, Sony makes 49 cents in sales. Looking at the industry average, which is at 0.27, we can see how in this regard, Sony is doing quite well. Now we'll look at another ratio called the debt ratio, which tells us proportionally how much of Sony's assets are financed by debt, be it by investors or borrowing. Sony's total debt was $7.95 billion, and we divide that by the total assets, which were $148.35 billion, and we get a 0.05. This means that for every dollar in assets, only 5 cents are obtained in debt. This may seem like a good thing, but it's an extremely low ratio, which can mean that Sony is missing out on an investor opportunity. The next ratio we look at is the times interest earned ratio. We take Sony's operating income and divide it by the interest expense. And with Sony's numbers, they yield an 11.5, which means they can pay over their interest charges 11.5 times over. However, the industry average is 22.8. The last ratio we look at is the ROE ratio, or the return on equity ratio. This ratio is extremely useful for comparing the profitability of a company to that of other firms. We take Sony's net income and divide it by the common equity and find that it will yield a 6% return on equity. However, once again, the industry yields a higher average at 13%. Now we begin looking at margins for Sony. The first one being gross profit margin. This simply shows how much money the company has after paying its cost of goods sold. We take Sony's gross profit and divide it by the total revenue and find their margin to be 25%. This means for every dollar in sales, Sony is left with 25 cents after paying its cost of goods sold. The industry average is 30.76. The next margin we will look at is the operating profit margin. This is used to measure a company's pricing strategy and operative efficiency. We take Sony's operating income and divide it by their total revenue and find that their operating profit margin is notably lower, which means that Sony should consider working on their operating expenses. The last thing we will look at for Sony is their free cash flow. Here's listed in 4 steps how to obtain the free cash flow. By following the first step, we get Sony's net income on a cash basis. By following the second step, we get the investment net operating working capital. And the third step gives us the investment in gross fixed assets. The last step is just to add all these numbers up and we get 4.01 billion, which means Sony has $4 billion to pay off their debt or pay in bond interest or dividend. In summary, Sony has some good things going for it. The total asset turnover times interest earn ratio, their debt ratio is low, which means they have low debt, and they have a healthy free cash flow. However, Sony wouldn't be our stock for no reason. Sony's operating profit margin is really bad, and their operating expense needs to be looked at. Sony's gross profit margin is low, as well as their return on investment and their return on equity. My final note would be that Sony is a titan of a company. They should not be overlooked and most likely just had a bad year.
Hi, my name is Chung Chung Lin. The stock we most probably will not buy again is Sony Star. Sony Star has low return on equity, low return on investment, and low free cash flow. In this part, we are going to prove Sony Star also is not worth buying again because of its low intrinsic value, high beta, low required return rate, low price to earnings ratio, and high price earnings to growth ratio. First, we will calculate the intrinsic value of Sony Star. As of today, Sony Corp's project free cash flow intrinsic value is $33.02. The start price of Sony Corp is $29.4. Therefore, Sony Corp's price to intrinsic value, it means project free cash flow ratio of today is 0.9. According to our class, we can use both dividend discount model and the dividend growth model to calculate intrinsic value of a stock. Second, Sony has a 1.94 beta. Beta is a measure of a volatility or systematic risk of a security or a portfolio in comparison to the market as a whole. Because Sony has a high beta, so Sony stock is not stable and has a relatively high risk. Third, expect rate of return on Sony's common stock equal 2.99% plus 1.42 times 14.2% minus 2.99%, which is equal 18.97%. Here we use CAMP model, which is capital asset price model. We use risk-free rate plus beta times risk premium to get expect market return of Sony. Fourth, we will calculate price to earnings ratio, which is a ratio equal price divided earnings, and the Sony stock's price earnings ratio is 27.89. Lower price earnings ratio means more earnings. So when we choose a stock, we prefer to have a stock has lower price earnings ratio. And the Sony stock has a high price earnings ratio, so it means Sony stock has lower earnings than other stocks. Finally, we need the calculate price earnings to growth ratio. It's simply using price earnings ratio divide growth rate, and the Sony stock has a 29.4 price earnings to growth ratio. because lower price earnings to growth ratio means higher growth rate. So lower price earnings to growth ratio is better than higher price earnings growth ratio. But Sony Star has a high price earnings to growth ratio. According to our calculation of intrinsic value, beta, and the capital asset pricing model, and the price earnings ratio and the price earnings to growth ratio, we have a conclusion that Sony Star is not worth buying again.
This concludes our presentation. Thank you for your attention.